Good day, everyone. Yeah, welcome to another lesson here in the Forex Manual of LC Forex Academy. In the previous lesson, I talked about price action, and I did good justice to that topic. You want to go back and check that topic is very critical. You want to check how the market makers book price using IPTA, that's the interbank price delivery algorithm, with respect to looking for a quote for liquidity and filling an imbalance. And you want to see how they drive that up and down with respect to the current tide of the market, which is bullish institutional order flow and bearish institutional order flow. When you are in a bullish institutional flow, you see higher highs and higher lows. That's your basic market structure. When you're in a bearish institutional order flow, you see lower lows and lower highs. So when you see the bullish, you are likely to see a BC being formed, a buy side imbalance, sell side inefficiency. When a bearish institutional flow, you are going to see a bearish condition being formed. That's your CB, which is your sell side imbalance, buy side inefficiency. So I talked a great deal of that in that previous topic. So you want to go back and watch that. And I believe some of you might have some questions. So you want to ask them in the chat channel, and I and the rest of the tutors will be available to answer you. In here, we want to go over to this new topic, market cycles. Okay, so this is lesson 5. This is lesson 5. Market cycles. So let's know more about market cycles. I always drop a quote for you that let no one deceive you. This market in which I trade on a consistently profitable basis is never random. The market is never random, so you can profit from it. It's not like a Bet Naija. It's not a betting platform. It's not gamble. It's consistent. If it were not consistent, there's no way I and some traders which are not as profitable as I am, we trade on 100 different occasions and I will always come out more profitable. It cannot be like that. And when you see a profitable trader and a less profitable one, you can be able to see the difference in them, even if you give them 1,000 chances to trade. It's not by luck. So, like I said in the previous lesson, the market is dynamic and it's not static because it changes its condition with respect to time. The following market conditions are seen in the marketplace. So I said that the reason why I don't trust indicators is because of they are lagging and not leading. Also, on that reason is that they're not able to get updated to the current market conditions as we go further more in time. Now we are in 2023. In 2024, we might see a different market condition play out, and these indicators was built to follow a specific pattern, and the market condition for that time may have modified and have changed to a different one, which might not really be in tune with what it was the indicator was being programmed to do. So that's my issue with it, and I don't trust indicators. So one of these market conditions we are seeing here is expansion. The next one is retracement, consolidation, reversal. So let's just go and see how they look like. First of all, is consolidation. Now, in the normal space, when you hear the word consolidation, you know that it's a build-up, a build-up, a build-up, a build-up to make stronger. Understand? Consolidation, a build-up to make stronger. So when I say consolidation in this marketplace, I'm referring to a build-up of the market makers orders. It's not showing you random position, but it's set to occur when price move inside a clear trading range. It will show willingness to move. It will price does not show, sorry, that's an error. It does not show a willingness to move significantly higher or lower. Here is meant to be does not show, does not, will not show, or does not show anyone. Okay, so when price consolidate, indicate that the market makers are allowing others to build up on both sides of the market. So when they are consolidating that price, that means they are keeping it within a range by which there will be so much sentiment, some of the traders will say it wants to buy, and some traders will say it wants to sell. So they will place buying orders. Some traders will place selling orders. They are not decisive of where the market will go to. So these market makers, they keep price in a trading range. It is there. It is not going out of that range. It is there. So they keep it for sentiments to build up on both sides of the market. But we as IOC traders, we don't trade in consolidation because we know that it is the manipulative time. We don't stay in there. So when we see a consolidation, we expect an expansion near term. So how does a consolidation look like? This is it. You see inside this box, price stays within this range. It is not making higher highs, neither is it making a lower low to this low. It stays inside this range, and you see it like that. This is a consolidation. The next one we're seeing is expansion. Is when price moves quickly from a level of equilibrium, or when it leaves the consolidation, where it moves up. We talked about buy-side imbalance, sell-side inefficiency. When we expect an imbalance in price, it moves up or moves down. That is an expansion in the marketplace. So we see this in the marketplace go mostly after consolidation. When price leaves a level quickly, this indicates a willingness in the part of the market makers to reveal their intended repricing model. So when they expand price, either up or down, we get to see with a clearer view where they want to take it to. Understand? They will show you their footprint before they get there. Understand? So it's not like indicators that follows price. They show you what they want to do before they do it. So this is an expansion. You see price here in consolidation in a trading range, and you see this large green candle here. It left the range. That is expansion, making a higher high to this high and to this high. It left the range up. So that's expansion in the buying format. Now, retracement. What the retracement means is when price moves back inside a recently created price range. So when price returns inside a recently created price range, it indicates a willingness on the part of market maker to reprice to levels not efficiently traded for fair value. Now, what I mean by this is when they retrace price, I told you when they expand it up, creating a void, they want to bring it down, to be able to rebalance an imbalance. That's the retracement. They rebalance the imbalance in price. They rebalance the void kept in price, and also to add up to their existing orders. So, like I said, it indicates a willingness on the part of the market maker to reprice to levels not efficiently traded. So they cover up voids that were not efficiently created or traded. Understand? So that's the purpose of them retracing a particular price in the market. So you see now they expanded. This is expansion up, making a higher high, but they retraced down to be able to cover up this void that was being created, because it's just like a paint. If you roll a paint, if you're painting a room and you roll the paint up, you have to roll the paint down again to be able to cover up the patches that were left. So that's how it is. So you see the paint is being rolled up. You have to roll the paint down again to cover up patches that were created when you rolled up. So that's what the market maker is thinking. When they bought this thing up, there were some places that are not efficiently traded because of the high volatility. When I say high volatility, I mean speed. The high volatility, the high speed that was given to the market to go up. So they reprice to those levels and cover up the prices not efficiently traded to. Understand? So this is just like buy-side imbalance, sell-side inefficiency, buy-side imbalance. You'll see the sell-side later on. It goes on like that. So the reversal, that's the last condition. Reversal is when price moves in the opposite direction to the most recent prevalent direction. That's when the tides of the market have changed. We said previously that we have two tides of the marketplace. That's your bullish institutional order flow, that's your buy tide, and your bearish institutional flow, that's your selling tide. So when it changes from either bullish to bearish or bearish to bullish, we see that the tide of the market has changed and a reversal has otherwise occurred. So when price reverses, it indicates the market maker has run a level of stops. That means they have taken out liquidity. When they want to reverse price rather, they make sure that they have taken out liquidity and a significant move is being done in the opposite direction. Now, we see this is a reversal. They took out this liquidity here, this high here, before they turned price down. Before it was making higher highs and higher lows in a bullish institutional flow. Now it's making what? Lower lows and lower highs because it has changed from bullish to bearish. So that's the end of this lesson, but I want to take it to the chart so that we'll be able to see for a fact how these 4 conditions play out in the marketplace. Okay, so I'm still using our example we are using here before. Now, you can see that as the markets expanded up, they ran a level of stops, and we also saw that when we took our chart back to history, we saw that they took out a level of stops here by taking out those highs. They took out stops, they took out liquidity, they took out the stop loss of retail traders on a fund money. After they took out their stops, their stop loss, then they reversed price to the other direction with speed. The market consolidated here. It stayed within a range, but we don't come into trade here. We don't come into trade here because we want them to show us their footprint. When they expanded price down, it showed that, oh, they are now willing to sell. So their manipulation is done. But I too, I trade in consolidation, but that's for a professional. That's not for beginners. Understand? I'm advising you because you're a beginner. But I will tell my master students where to enter inside this thing, and we can still trade it. But it's not for beginners. So this is a trading rate. We don't trade here. So you wait for an expansion down. So this is sell side imbalance. You have a what? Buy side inefficiency. But where will they stop? How will you know that this is the end of the retracement? So this is consolidation, expansion, retracement. How will you know that this is the end of the retracement? Like I told you, I really cannot put everything in this particular course. You have to go for more information. So they also expanded, then they retraced, still into this range. Retracement, expansion, retracement, expansion rather, retracement, expansion. Now they did what? A reversal. Before they did the reversal, watch, they took out some level of liquidity by taking out here. So they went up, expansion, retracement, expansion, retracement. They did a little bit of consolidation around here to build up orders. And they went up with what? Speed. After that, they reversed. We said that they take out liquidity before reversing. Where the liquidity that they took here, you see it is in form of this old high. Look at this old high here. They took it out before going down. So they changed the order flow from bullish to bearish, making lower lows and lower highs. So expansion, retracement, expansion, retracement, expansion. They consolidated around here. They want to reverse, but before they need to do that, they need to take out some level of stop loss of retail traders in a form of old lows and old highs. Where are the stops we saw here is in form of this old low here. They took them out. Expansion, retracement, expansion, retracement, expansion, retracement. Consolidated around there, a buildup of orders. What will they do then? They will expand with speed, expand. Here they consolidated with the consolidated price here again. What should we wait for now? Retracement. This expansion. This expansion now tells us what they want to do. It shows all their footprint. We know that they have not reversed price because a level of stops have not been taken and they have not reversed price. So we see this expansion as a form of retracement to continue their buying orders. So they bought up, retracement down to a point to add more orders to what? Buy again, expansion. Now, consolidation, the consolidated price, yeah, wait for what? Expansion, retracement, expansion, retracement, expansion. And so you have it. At the point of reversal, look at reversal here, right? It's as if they did not take out stops here, but let me show you something. If I put a line like that, let's track where they, what they took out before they came there. So let me go to higher time frames and I look. So this is another form of, on a higher time frame, this on that form of rebalancing and imbalance, which is taking me to higher concepts. So let's just stick to what we are doing now. So expansion, retracement, expansion, retracement, expansion, retracement, expansion. Before they reversed here again, they took out a level of stops. What are the stops? Old lows, form of what? This one here. Took them out and they expanded down. Before they turned the thing from bullish now to bearish again, they took out some stops in form of this old high. So the market does not change. It just obeys the underlying factors for its movement to take price up and down. So if you study that, you're going to see a great deal of that. What you need now, if you understand the model, you understand the price action with which they use, now you should begin to know how they come in, how they go out, at what point do they reverse. You need to know all these things down to your fingertips before you can come in to trade in this market. So go over this course again. This one is shorter than the previous one, I believe so. So go over this again and check for the different market conditions and cycles we have in the marketplace and how they move with respect to quote for liquidity, filling and imbalance, with respect to the tide of the market, either bullish institutional flow or bearish institutional flow. Bullish obeying the BC, which is your buy side imbalance, sell side inefficiency, or the bearish obeying your CB, which is your sell side imbalance, buy side inefficiency. So I believe that once you have done that, you're going to see a great deal of things open up to you. So I'll be going to the next lesson, which is your price for freedom. That's your next lesson. So I'll see you there. Have a nice day. I remain your friend mentor, IUC. I see you in the next lesson. Thank you very much.